Good evening, investors. First of all, I would like to welcome everyone who has logged into for this webinar. We have already crossed more than 800 to 1000 people who have been waiting patiently for this webinar. First of all, I'd like to thank them for participating this, and every webinar you have been making it a very successful one. This clearly shows that there are a lot of questions and interest. And before that, before going to the key speaker, I'd like to introduce Mr. Rohit Singhania, who is the DSP BlackRock Fund Manager for the ELSS, for the Tiger Fund, and other various funds. He's just been there in the system or in the market for quite some time, and a known name in the market as well. Thank you so much for honoring our request, Rohit. Before giving the stage to you, I think there are investors who are very keen to know about the way market scenario is also provided for the last 10-15 days. The question remains the same: is it the right time? That's a mostly frequently asked question from our investors. And what is the mutual fund scheme? Which one should they select? Or what is now that the ELSS fever has caught up very much in the market? Now the tax season is coming out. People are really wanting to plan this way ahead of before the March. So it will be very glad to hear from you what exactly should be your views before getting into the ELSS specific. Your views on the market and your overall views about the current situations. I leave it up to you for our investors.
Thank you, Sampath. Good evening, all. I think, when one talks about market views, I think there are so many things to talk about, things which you don't understand and things which you understand a lot. So I think when you're investing in equity markets, as we say, you put more weightage on what you understand more and less weightage on what you understand less. So by this, what I mean is, like, take for example, we talk about markets. Let's talk about an individual stock. So as a fund manager today, if I buy a stock, what do I look in a stock? I say, okay, what is the profit growth for last 2 years? What can be the profit growth for the next 2 or 3 years? If today the ROE of the company is 10%, can after 2 years it become 14%, 15%? Or what is the trend? What is the cash flow going to be of the company? What dividend the company is going to pay? I look at all this and then I decide, okay, I'm getting this company at this price, so I will buy it. Okay. So this was a simple decision for me. I took a company call and I bought it. Now what happens is, I like the company, I want to buy it. But someone comes and tells me, China may cut interest rates, US is going to hike rates. What happens if Trump wins the US elections? What happens if Hillary wins the US election? Then what do I do? So now if you ask me a question, let's take one by one. Is China going to devalue the currency? Do I have an answer today? No, I don't have an answer today. If I say yes to you, then you'll ask me how much are they going to devalue? Do I have an answer for that? I don't have an answer for that. Can I calculate that as I calculate my company EPS? I cannot calculate that also. Then you'll ask me who's going to win, Trump or Hillary? I would say I don't know. People said if Trump wins, it's good for pharma. If Hillary wins, it's good for IT. But today you don't know all those events, right? Is US going to raise rates? I don't know it's going to raise rates. So if the things which I don't know, what do I do for them? So if I like a stock, but you tell me all these things are there, but the markets can fall or markets can rise if whatever this happens. So idea is, if I'm confident about stocks, I will buy the stock. I will not say and I'll wait for the event to happen and then I will buy the stock or sell the stock. See what happened on the 21st of June, Till 21st of June, for last 4 months, we were talking about what's going to happen in Britain, whether they're going to opt out of the European Union or they're going to stay in European Union. Everyone thought it will be a mayhem. All the world markets will correct, so emerging markets will correct, and so India will also correct. But we all know what happened after that. The kind of flows we have seen, the kind of stock market pickup we have seen, right? So in the end, what I want to tell you all is, what we look at buying in stocks, the same should be looked at buying a mutual fund. And an example I give you today, I suppose a stock is 100 rupees. I think the stock is expensive. At 90 rupees, it will become a buy for me. If these kind of events happen and say the stock comes down to 90 or 95, am I happy? Yes, I am happy. Because the stock which I wanted to buy, where I saw there's economic value in that particular stock, I'm buying the stock at that price. Yes, my portfolio that 1-2 days may correct because the market is correcting. But it is correcting of an event which I cannot plan. It is correcting with the event which I have heard of it. I am expecting it may happen, it may not happen. So one. Two, how do you benefit with these kind of events? So technically, you have sectors, you have companies. So today, if you'll tell me US is going to slow down or China is going to grow very tremendously, so I know which companies in India are linked to those businesses. If there's a bad news in China, which stocks will fall more? If there's a good news in China, which stocks will rise more? So what do you do in these cases? So again, without naming stocks, I'll give you an example. Today, I feel there is one company who's directly related to China. People think if China is doing good, that company will do good. Fundamentally, I like the company a lot. Fundamentals, the ROE, the EPS, the book value, which I told you, is all good. But people are talking about Chinese currency devaluation. If there is pickup, what do I do? Do I not buy the stock at all? No, I still buy the stock because the fundamentals of the stock are very strong. But what I may do is to be try to be a little smart. Is okay if I want to buy 2% weight in that stock, I will say let me buy 1.5%. Whole world is telling me in next 1 month or 1 week that event is going to happen. So in case the event happens, if the stock falls more, I will buy that half percentage points later on. But will I not buy any? No. If the fundamentals are good, I will buy it. Reverse happening in selling. Suppose that the stock has reached my target price, or maybe I wanted to buy a stock at 100 and say I'll sell it at 150. Stock is at 140, and then these events are happening. So I'll say, should I wait for the selling or should I sell a little bit more right now? So those are the decisions you take. So what I'm trying to tell you is be very important on earnings. If the corporate profitability is growing, even if the market corrects because of reasons which are not in your hand, you can take the benefit out of it. That's one. Two, if you look at it, second part is we talk about macro. What is happening in India? What is the inflation? What is the GDP? What is the government doing? Is the government not doing anything? So again, where numbers are concerned, I think we talk about fiscal deficit, we talk about inflation, current account deficit, interest rates, GDP. If I look at the key numbers, I think India is very well placed in all these parameters. So, which was a concern 2 years back, right? We don't know whether GDP was growing, we don't know whether inflation was growing, what is the current account deficit, fiscal account deficit. The second thing, which is a major positive, is our macro is doing very well. Come to the politics part of it. There, if I am a negative guy, I'll have 100 negative points. If I'm a positive guy, I'll have 100 positive points. But what is the fact for you and me to realize? At a given point of time, what is required and what is expected. If you don't do what is required and you do what is expected, is it going to help you? I'll give you a simple example. Take power sector in India. Till 2 years back, you spoke to any power company, they said we don't have domestic coal. We did an PPA with Coal India and they said we cannot supply you coal, so we are now into NPA, our power plants cannot produce power. When the new government came in power, what did they do? Did they say I'm going to set up 1,000 megawatts, 1 lakh megawatts of new power plants? Or said, okay, coal is an issue, let me find out. They tried to find out solutions for coal. The coal production in India started going up in the last 18 months. Today we are surplus coal. Every May, June in newspapers there used to be an article, X plant has got 7 days of inventory, 5 days of inventory. Today we have an article saying there's extra inventory in the system of coal. So basically what I'm trying to tell you is, yes, setting up more power plants means more capex, more money in the system. But do we require more power plants if the power plants which are already set up, they're running at 60% utilization, they have no coal. So what is the use of doing that capex, right? So this is one example. So if you look at minutely this government in terms of whatever action they have taken, I think they have tried to solve the on-ground solutions. Like take for example this petrol and diesel price hike. Today staying in Bombay, I think any person on an average travels 45 kilometers a day. Had they not kept the petrol price where they are and to increase the excise, the number of cars in Bombay street would have been 20-30% higher today. Where the traffic would have gone today, if I would not take my car to office every day, I would say, okay, petrol is 40 rupees a liter, let me take my car. But is it a productive expenditure? No. So what they try to do is, wherever there was importance of something which they need to do, they have done it. Yes, there are some sections who believe a lot of things more could have been done, but I think there's still time. There's still 2 years, 3 years in this session for them to do things. So in terms of the government policy, I am personally very positive in terms of how they are doing things, how they are going about it. So keeping the fundamentals point in view, I think India and Indian equity market is well placed. But you will have instances like this, whereby the global news flows will, impact and take a overdrive maybe for 1 week, 1 month. But you have to tide over it. Lastly, what's happened in the last week in terms of what the government has done for the black money, you can't plan for these events. And today you would ask me, long term it is positive. Today the companies also whom I'm speaking to and asking them what kind of impact they may have. So even they are assessing it themselves. Today as a fund manager, I cannot tell you, this sector will be positive because the companies themselves who are doing business for so many years, they are still yet to gauge this is going to be my loss or this is going to be my gain. So to answer exactly today at what point things can improve, I think by next 15 20 days we'll have more sense while talking to companies actually what's happening on ground rather than giving a personal view of what we think it is right or wrong, right? So I would still wait for 15 20 days, but overall long term I'm sure it's going to be positive. For the next 2 or 3 or 4 months, how it pans out, probably we're still working out among ourselves, what can be the impact for that. So this was quickly in terms of how we see the markets. Secondly, I get a lot of questions which I thought, let me address it right now only. We take comparisons, fixed deposits, real estate, gold, and equities, and we see, how is equity performed. So always in bad times we get that question, real estate and gold is better, diamond is better in some cases. But what happens is today I'm buying a real estate and I'm buying an say a flat in Lower Parel sitting out here. I bought it for 2 crores today. The 2 crores will remain 2 crores in my balance sheet. If I go to sell, I may not get even 1.5 crores. But 2 crores is going to remain 2 crores, right? So I'm not seeing a loss. If you're buying a stock, if you're buying a mutual fund NAV, you're seeing the NAV every day. So you're saying, okay, my 10 NAV has become 9 rupees 80 paisa, so I've made a loss. But real estate, you're not seeing the market value. You're seeing a book value and you're happy about it. So I can see the 2 crores in my portfolio. So that is one thing which needs to be corrected. Gold also, if you look at it over the last 10 years, if you remove the appreciation of US dollar versus the Indian rupee, you will see gold has also not performed very well. And equities, it's been proven, I'm sure these guys must be talking to you all when they talk to you all. Over a long period of time, equity has got a very big compounding impact in terms of profitability and returns. So I would surely suggest, you may think gold, real estate is something, which is more visible for you. But as a long-term investment opportunity, I think equity is one which should not be missed. So I think this was what in terms of the equity and my view. Coming to the ELSS, as Sampath mentioned, so let me put it in very simple words. Today, when you talk about tax saver scheme, people compare it with a 3 year close-ended scheme, right? They say it's a 3 year money. So, but I think it's a big difference between a tax saver scheme and a 3 year close-ended fund. Why I'm saying it today is when I look at my fund, also tax saver fund, DSP BlackRock, which I manage, more than 40% of the money or 50% of the money is more than 3 years old. So it is not like whatever money I'm managing today, I have for 3 years. It is like people who have invested money 3 years, 4 years, 5 years back. They are happy with the returns. They have seen the returns, so they don't remove the money, right? They continue to be invested. So today, if I think my portfolio is 100 rupees, I will buy stocks worth 90 rupees, which are going to give me returns after 2 years, 2.5 years, because a closed-ended fund. It is not the case because it is the new money coming in today. Yes, it is closed-ended for 3 years. You cannot withdraw it, but there's a lot of money which is there beyond all 3 years, 4 years, 5 years, and if the returns are coming. So how I look at it and how I manage it is basically I take it as an open-ended scheme. I don't see it. I don't buy an 80% of my portfolio saying after 2 years it's going to give me returns. So I have stocks which I have planned. Okay, if I need to buy this, wait 1% after 12 months, but there is market liquidity. Maybe it's a mid cap or a small cap stock. After 12 months, I may not get to buy in 1 or 2 days. So I say, okay, let me start building a position today only, and maybe in 12 months, 9 months, 13 months, whatever weight I want to have, I'll do SIP in it, so that when I think things are turning around, I have a decent weight. Stocks which I like for 6 months, 9 months also, I think, maybe there's some change in fundamentals of the company, or there's some change in the sector, or company is doing something differently. I don't mind buying stocks for a 9 month, 12-month view also. Because again, when I see opportunity in terms of earnings growth, some mismatch in valuations compared to peers, some macro thing happening in terms of there's a change in government stance, or the world economic order is changing. Maybe one sector is expected to do very bad, one sector is expected to do very good. So all these things play a key role. Rather than saying, okay, it's a 3 year money, I'll take the money and say I'll see you after 3 years. It doesn't work like that. So I think that's one important thing to look at. Second thing is, I don't know, so I keep on asking these questions to whomever I meet. We have a habit of doing SIPs in a diversified equity fund. We do SIPs in other funds. But in a fund like TaxSaver, SIP is never mentioned. So the feedback I get from your colleagues and other people are, since it's a lock-in money, so if they do an SIP, then if they want to withdraw after 3 years, they will not get the money at one time. So all I'm trying to say is think about it, yeah. Today you try to do an SIP saying, okay, the market impact I'm trying to reduce it. If I'm investing regularly, why can't we do a 12-month SIP in a tax saver fund also? I mean, okay, at the time of withdrawal, but when you're putting the money in, it's not like you're putting the money in for 3 years. It's not like it's a child education fund. You're putting the money is one to save tax and to earn some equity returns. You're not putting in the money in a tax saver fund saying, okay, after 3 years, my child is going to go in 11th standard or my daughter is going to get married, so I'm putting in a tax saver fund, right? So I think one should really promote and look at it in terms of SIP also. Why can't you do an SIP in a tax fund? Why only a lump sum payment and say, okay, December the markets have gone up, how should I put it? March the market has come down, is equity market bad? Why do you take all those timing calls? Because today timing call, as I give an example for stock, if I buy a stock at 100, I don't know whether I'm buying it the lowest. It can fall to 95 also tomorrow. But today if I feel 100 is the right price, right valuation, I'm happy buying it at 100 and saying, okay, let it fall to 95, I'll buy more. So I think that is one thing I should really look at it in terms of how people look at tax saver funds, lump sum, lump sum. But I think a SIP opportunity is there. Thereby, you can average it out. You may sometimes maybe you may say, okay, I never invested at one time, the market's corrected and what, but it's fine, yeah. Over a long period of time, as you have seen how SIPs benefit, you have the benefit in the tax saver fund also.
So Rohit, sorry, I'm going to cut you there because the questions are frequently asked on these. The most frequently asked questions is, you just touched upon a very very sensitive thing which we even at the branches we tend to face from our investors. FD vis-a-vis mutual fund, vis-a-vis any other investment product. I think today's scenario, how do you position mutual fund as a product towards all the other saving, because the falling say interest rate scenarios?
See, today it's become a little simple for me, Sampath. All the banks have been reducing their deposit rates.
Absolutely.
So earlier you used to get a 2 year, 3 year deposit at 7.5%, 8%.
Okay.
Today I don't think anyone is giving more than 7.5%.
Yeah.
Plus
right.
you pay a tax of 33, 34%. So net post-tax return is 5.5% for an FD, bank FD. If you look at equity mutual funds, so though you cannot guarantee the future returns, but when you talk about the past, what's happened, and you adjust it for tax, if you hold it for more than 1 year at zero tax, I think it's a much efficient way to invest into mutual funds.
Absolutely.
So yes, everyone, you have these guys to advise you in terms of what kind of investor you are, what age group, what income level. But I would still say in this kind of a scenario, equity should be the top investment, rational rather than anything else.
Absolutely. I think my conviction is getting strengthened with those nice words, which is what we have been advising our investors as well. With the current scenario, current situation, the way you have get a longer term horizon, investment horizon, and come into an investment like mutual fund, preferably on the SIP routes. I'm sorry, since I thought really got excited when you touched the most sensitive and mostly asked question.
No.
So either I'll cut you there and ask this question on behalf of my investors as well.
Correct.
So you can continue with the ELSS.
That was pretty much in terms of the overall thought of ELSS. In terms of our DSP BlackRock Tax Saver Fund, as you see it today, we are about 67% invested in large cap, and the balance is into small, micro, and mid cap. In terms of positioning, we are overweight on materials. Okay, that's the big sector we are overweight on, and we are overweight on industrials. Where we think, today, and why so? And we are underweight on IT, we are underweight on pharma, we are underweight on consumer staples. The reason is, which sector are you seeing growth? Today, when you're talking about GDP of 8, 8.5, 7, whatever it may be in the end, which sectors will contribute growth towards it? Okay, traditionally we talk about IT, pharma being the best. But today, if you look at the earnings growth of the sector, they are no more there. So, why at one point of time, people are buying IT stocks at 25 times, 30 times PE, right? The reason was the stocks were showing earnings growth every quarter of more than 7, 8%. YOY growth, 2%, 3% quarter on quarter growth. That segment was showing surety of profits, therefore they were seeing a PE expansion. Today, when you don't see that surety of profits, you don't see profit growing. So why you want to give them a higher multiple? Multiples contract with earnings, multiple expand with earnings. So when you're seeing a trend, so that's why even a tax saver kind of a fund, I'm overweight, I mean underweight today. People would say your maybe markets at the high, markets may correct, so you should be overweight on IT and pharma, right? The idea is these sectors have no earnings growth. So what happened maybe 3 years back in the down cycle where IT and pharma outperformed, it may not happen going forward because the fundamentals of the sectors have changed. So I think that's how the positioning is there. Materials, so we have a lot of cement, we have commodities, we have a lot of building material companies, we own certain consumer companies, where everything in terms of some business part or some strategy of the company is doing well. And I know if I hold them for next 1.5 year, 2 years in some cases, they're going to give me exponential returns. So again, it's terms of bottoms up in terms of which company is doing what. And that is making my industrials or material sector overweight. It's not like I want to be overweight on industrials, I want to be overweight on materials. No. It is because the companies which I like, they are making the sector overweight or underweight. So I'm fine with it. So I run it in that way. It is a pure in terms of I diversified. I can invest. I have no restrictions in terms of where I can invest, which sectors I can invest. In terms of number of stocks, we are at about 65 stocks. And again, the number of stocks people talk about it, but there's no science to it. Whether 50 is better or 70 is better. As long as the stock selection is good, I think that is a key for me in terms of how I look at it. So I run it as in predominantly like a diversified fund. But yes, part of the portfolio, I buy it and saying, okay, I'm taking the stock for the next 2 years, 3 years, or I'm going to build up my position over the next 1, 2 years. But that is not the full of my portfolio. That the major of the portfolio is run as an open-ended equity fund, and which can give me returns in 9 months, 12 months also, and give me returns in 24, 36 months also. So I think this is what I had to say about our tax saver fund. And now we can take more questions, Sampan.
Sure, we can do that. Before that, I think there are questions flooding up. You have the option of taking this question. That question will come last. Uh, they're just keen about knowing on your top 10 holdings.
So I would say, I mean, I cannot discuss individual
Yeah,
stocks,
individual
but
stocks,
if
you
you look
don't
at
need to, yeah.
my portfolio, if I actually does out, so
Yeah.
the top 10 holding would include a lot of financial names, one or two pharma names, like we have SBI, HDFC Bank as a top holding, Sun Pharma is one of our top holdings. These are the key names, and again, the top holding is just because it's not a big name or big market cap. You have certain things which are going for an individual business or individual company, which we think will help them in terms of growing their profits and therefore help them in terms of growing the stock price. So that's how it is, right?
Absolutely,
Yeah.
absolutely. So, what do you think? How would you position? Would you like to be there? Your performance has been there, somewhat inconsistent the last year, and then it has bounced back. Has it been corrective measure has been taken? I know investors are not keen to know that you're always there in the top one or top second, but what can investor expect in the next 3 years? Not the percentage. It would be unfair to go and ask you what kind of return you would give. But do you feel your fund to be positioned at least in the top quartile or
So
top five
the
for the
KRA
next?
given to me by my bosses is, not being number one or number two. It's being consistent. Either you be in first quartile or top second quartile. That is what is my KRA. My KRA is not going to be number one always for 1 month and then become number four or number 10 for next 2 months. It is consistency what I'm looking at it. And if you look at it in the last 2 years, since I've been managing the fund, I mean, you can have a look at it in terms of the consistency of performance. That is what is important for me today. Rather than being number one in 1 quarter and being happy about it, and being number 100 in the fourth quarter.
So I think that's exactly what even our investors are very keen to know about. The consistency is what they're also looking at from your fund specifically. Even though it is out of the topic or out of syllabus, we can call a couple of guys are more keen to know about your Tiger Fund. Would you want to just mention few lines about that?
Yeah, so I think Tiger Fund, as I mentioned in the beginning, right, what the government has done in terms of solutions for problems, and they have not announced new power projects, they have not announced new steel plants, cement plants. But again, there's a reason for it, right? There was overcapacity in a particular sector, issues there. So no point saying I'm going to build more capacities, right? Plus, if you look at private sector also, their capex has been low over the last 3, 4 years because in terms of their cash flows, again, it's not been that great. But the expectation is again coming back to the GDP number. If I have to go to the GDP of 8.5% plus over the next 1 year or 2 years, consumption is fine, but if the what do you call that, as as the free cash flow formation or cash formation, or in the word infrastructure spend, if that doesn't pick up, then the GDP of 8%, 8.5%, I think it's very difficult to look at it. So keeping that in mind, this space, I'm today quite getting more confident on it. But as I tell in all my investor meets, and I'm telling you in this forum also, views today is if you invest 100 rupees in an equity mutual fund, I would say around 17 to 20 rupees should be in an infrastructure fund. The reason is, if you look at valuations, if you look at the outlook and the earnings growth for companies which you have, I think the bottom, I mean, it's never to predict, difficult, never easy to predict a bottom, but I think we are somewhere there in terms of valuation and outlook. So any trigger from the government, any trigger from the private sector, I think should be a boom for this infrastructure and infrastructure related companies. So yes, budget is there next year, first week of February. I think that's when, and it's going to be the third budget. I think that's when you will see more push on infrastructure coming in from the government side, and that's when, by that time, in the private sector issues would have been resolved to more extent, and when I expect them to report, better profits and show some more confidence in setting up new capacities. So I would say tactically you still have 2-3 months time, but yes, if you invested 100 rupees, I would still say 70 to 20 rupees should be in this kind of a theme. So even if, as I mentioned, my tax fund, right, and I said I'm overweight on materials and industrials, it in a way tells me my thought process. So, I'm inclining to, but will I have the same amount of infrastructure as I have in my Tiger fund, in a tax saver fund or opportunities fund? No. It's going to be limited.
Absolutely.
That's what it is.
Absolutely, absolutely. I think you covered most of the questions. Before winding up or before asking few more questions, see, this conviction on SIP has been strengthening year on year, which we have been seeing since you have also been there in the industry for quite some time. But the frequently asked question in terms of ELSS, even though you covered, it's going to be repetitive for the benefit of our investors. They always have this, it's close-ended scheme. I need to enter only in lump sum, or should I get into the SIP? At this kind of a scenario, right now, being markets being so volatile, what would you really
See, I think
recommend or
I
suggest?
I think in any scenario, SIP is the best mode to invest in. But some people like taking options of market fall or market rise. Like that's what sometimes I try to do it in stock. Whether I get it right or no, my hope is at this price is cheap or this price is expensive. So yeah, that you might take a trading or tactical call. But I think SIP outweighs everything here.
Absolutely.
I would say that.
Absolutely, absolutely. I think we have covered most of the questions. Last but not the least, if I have to ask you tricky or rather whatever question which you have the option of avoiding it. If I have to ask you Tiger or equity opportunities or ELSS, which is the one which you would make a tick mark at this point of time, because we have been recommending a great fan of, and there are investors also a great fan of your own fund house, Microcap, which became a huge hit last financial year. I'm sure that interacting with other fund managers also, they have come out very
So yeah,
positive
you are very
response.
simple for me, right? So as I said, 100 rupees if you invested in mutual funds, equity mutual funds. So ELSS and opportunity you cannot compare, because ELSS people invest for a different aspect, right? So if you invest at 1.5 lakh rupee and you assume that's outside, that's outside. So the balance 100, I would say 80 in opportunity and 20 in Tiger. It is very simple for me. That's how I look at it.
That's great, and I think on behalf of our investors, I'd like to thank you so much for your time. It's been a very fruitful, and you have added to our conviction that our investors need to invest, and there's no such thing called as the right time to invest, and SIP has been the right route, and schemes which we have been positioning for the investors' benefits to know more information or in-depth information direct from the fund manager's perspective. It has given us in the past that it gives a lot of insight to our investors who want to take the right decision. We HDFC Securities believe in giving the right platform. So honoring our request, coming at the right time and logging in, and helping our investors to help them in terms to achieve a right make a right decision. It's been very kind of you, Rohit, for making it here.
Thank you.
Thank you once again from HDFC Security side and from our investors for making.
Thank you all the best. Thank you.
Thank you very much.